Hey, welcome everybody. It's the Market Sniper, and I'm here to talk to you about macroeconomics today and what's been going on out there. It's a confusing old place. You know, the SPY is making a new high. Why would that happen? Well, it's the stagflation. As we've highlighted many times before, the market can go higher. However, some of those multiples are super stretchy. We're going to get to that in a minute. Within that, you have indebted consumers, all kinds of related issues from car loans, credit cards, and various other aspects that are clearly close to the end of their tether in terms of being crushed by debt. We're going to talk about that as well. And how could you actually have a pretty wrecked consumer and have a SPY at an all-time high market like that, and of course the Nasdaq. What is driving all of this? Isn't it supposed to be market good, economy good? How does it all work? And trying to make sense of all of that for you is what I'm going to be looking to do today. And at the same time, we're going to also give you some biases on how we think you should be positioning and what comes next. The role of gold. We're going to talk about oil down today and all the various aspects of this. Of course, the threat of war and all of those good stuff. So it's going to be a full-on journey. Let's do it together. So start with a couple of things that are probably worth posting. This comes out of the X profile. Just follow us. Some of the things we retweet. Some of the things we comment on, some of the things are general information. Remember, we haven't gone and deep dive to make sure everything is perfect. There's a couple of different numbers I've had sometimes when talking the same topic, but it's guide and principle. So wrecked consumer is our hypothesis, generally the man in the street. So let me just grab that box and put it in. We think the consumer is pretty wrecked. Now, I'm going to be showing you some aspects that will actually show the US consumer is considered resilient compared to the European, the Canadian, the British, and the Japanese. I've always thought there's something that just pushes the US consumer even further out, and that's often access to credit. So they'll even keep spending even when they're pretty well extended. So stock market is new highs, and this is the thing I'm going to keep bringing everybody back to. In terms of the understanding of the way of the world and where we are at, we are in a debt-based collapse, and it's begun, and you're already seeing it, even though you think, hey, but it's an okay day. There's no screaming headlines, etc., etc. No, you're in a debt-based collapse, and that is why you are unlikely to get the interest rates all the way back down. We'll take a look at that US 10-year, which is a benchmark debt instrument, and show you the chart on that as well when we talk more on that. So I'll be coming back to that. So what we're actually saying is you actually have a big asset class like the bond market sitting there, for example, and you have another asset class like the equity market. Now, in the good old days, there was a third reserve asset that people had a minimum of 5%, and you know what that is. It used to be gold. But that got completely definancialized and was, nah, what do you want that for? And it went away. So you ended up with what became known as the 60-40 portfolios, where you have 60% in the debt markets, and you'd have, my apologies, 60% in the equity markets. Let's call the left one the equity markets then, and 40% in the bond markets, which would be your stabilizer. You know, it never does anything too sexy, but on the bad years in the equity markets, it actually has typically a better year because there's rotation out of the scared equity market into the bond market. So it was quite a binary system. You were either left or you were right in terms of that, and you were flowing in between, and you got reapportioned. So in the periods that the equity markets, after outperforming, this was your alpha, had crash periods, your bond markets, which would be a lot more dull, would be trundling along like that, would actually have little bull periods when the equity market was down, and then when the equity market really got pumping again, would be flat and dull, but still giving you a little bit of a yield. So that was the kind of a stabilizer mainly. And since our 2020 call, that ceases to be the case. In short, it's not a stabilizer anymore. It got super volatile. Go and check our Substack for the 45% collapse. And it's our overall take in the longer run. You're going to have more of those bleed outs in the debt market. More and more people are realizing it. Pension funds, institutions that have bad demographics now need to trace more risk. And this is why we feel you're seeing ever stretched aspects in the stock market. Again, we're going to have a look at some other tweets below this flow that will be highlighting that, from market cap value, GDP value to sales, all forms of metrics that will be coming out. So you might be wondering, why is the stock market doing so well if the consumer is so wrecked? And here's what our primary hypothesis is. The word has got out about the debt markets, and the institutional money, the private money, everybody is running. I showed you the Zero Hedge article some 4 years after us with our chosen friends that were admitting as much in an article as a major insight piece. The debt market has turned. And this is something, the sooner people realize it, and the better they realize it, and the implications. And this is such a big thing. Why does he keep going on about it, you might think? Why is he saying that's such a big call that he made, rah, rah, da, 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 da. No. Understand this, the foundation of your system. So there's your pyramid of assets is debt, the foundation. You borrow money into existence, and there's an asset and a liability. Every time money is being issued, so the dollar and the T-bill go hand in hand. You have the UST and you have the dollar. To create more dollars, you're creating more USTs. It's as simple as that. When the government overspends, it creates treasuries, generally. Now people will go into the minutiae of the TGA account and all of this, and when's it actually released. And you'll go to other channels for that. But the truth of the matter is, in due course, there are stages. It's kind of like issued and authorized shares. Eventually, the point of the matter is, once they come into circulation, you have created proliferation. So whilst there are technical aspects that say, well, maybe not straight away have those dollars been released, is there straight away an inflationary fact? The key point I'm making is your foundation is one of fiat and debt. Everything else that you buy with that you consider to be assets, the property market, for example, then people buy cars, which are kind of not assets, unless you really know what you're doing and you're getting collectibles, and they can be pumped by excess liquidity. More money being poured into the foundation will push the pyramid higher. So as you keep filling it up with new debt and treasuries, all these asset classes will continue to move up. And you go all the way through into equities, various other things. So we have had a super expansive phase on this bottom layer of the pyramid. Too much money borrowed into existence with too much debt. But the debt is an asset for somebody else, because they're collecting those rates and the income that comes with it, and are holding the assets on the basis that you owe them that money and you're going to be paying it back. So what tends to happen is, if people don't like the return, they stop being buyers. And remember, a lot of this is institutional. Pensions need and buy debt because they want to have an income stream to pay their clients that are old people that want their pension payment, who were paying into the system throughout all that time. And eventually, those interest rates are either not high enough, or the capital shrinkage value on it is no longer good enough in real terms. So as we are now in an environment where the inflation is higher than the interest rates, you are in what is called a negative interest rate environment. So what is actually happening in my overall view is that you are beginning to see a far larger bond market see leakage out into other asset classes, and there's been too much of a binary framing of equity and bonds. So what you're getting is the money has to run somewhere, the liquidity of the wealth, it has to run somewhere, And as a result, it's going into already expensive equities and making them exceptionally expensive equities. There is, of course, some smart people that are bleeding it into the gold box. And we've even had Stanley Druckenmiller of climate change fame put some in Newmont and various others. So there are some hedge fund managers, and there are a lot of people that pretty much understand that we've got way too much debt and it's unsustainable. So there is also leakage out of the debt markets into the gold market. And of course, the central banks, particularly those not associated with the West, that not only will preserve their capital, but actually achieve undermining the unpopular West, are also going into gold, and they are part of the lead steer. So it's not the sole point. Equities are not the sole beneficiary. However, they are to some degree a beneficiary of a very big market. The bond market is huge. It's debt of everything. So that little dirty sketch explained. Let's just have a look at some of these tweets that we were putting out, or retweeting actually, of other people's information. Total credit card debt is 1 trillion. I've heard this before. I've seen some people say 1.12. Don't fascinate on the minutia. Some have said 900 and whatever. You're around 1 trillion and growing. I've also seen some people say 21.6% is the rate that people are now paying, but that might have been an old stat. It might be closer to 25 now, but the average interest rates are, that is usury. It is usury at the highest level, 25%. If you're on a credit card and you're paying that, you've exhausted every other line of credit which is cheaper, and you are in trouble. A credit card debt it's a poison pill way of getting something to eat. You'll feed for now, but boy, are you having to swallow poison pills for the future. And it's unsustainable. People in those situations that are in that space for a long time and don't have some other contingencies that are going to drop and alleviate their debt issue so that they can go back into, digging into their home mortgage and refinancing there, they are on a long hiding to nothing, especially if that's being expended on energy, filling their car to go to work, and not holidays as well. And I fear many people are doing grocery shopping on that level of debt. The average American family now holds 10 grand minimum in credit card debt. So on 25%, that's very, very expensive. Remember, it's compounding as well. You can't just say it's 2,500 for the year. It's compounding, and often compounding not at an annualized rate, but quicker than that. And they're adding to it all the time. 40% of Americans now have more credit card debt than savings. So that is 4/10 of the country are sitting that if you took all their net savings and said, I'm going to pay your debt off, you'd still have debt and they would have zero savings. Pretty ugly, that. Pretty ugly. Don't build a lot of super expensive debt. Non-advisory, just a comment. We're not qualified to advise at that level. If you have savings, kill that, but also at the same time have something in the savings pot so you don't feel like you have nothing. So that's the credit card. It's a couple of comments on where credit cards are at the moment in terms of the grand game and the consumer. So for me, the consumer is exceptionally wrecked state. We're going to talk more about it. There's other credit card listings. 1.14 of credit card debt. It's 50% up. So this is some additional stats. Welcome to give these guys a follow that are issuing interesting stuff here. Check them out. It's up 50% in the last 3 years. We know kind of what was the big burgeoner of the 2020, the collapse that put so much stress on people. It was very hard for them to get credit during this period. And then the post-COVID was the big run-up. I think you're at an all-time high here, sitting on credit card debt, and I'm not sure all of that gets paid off. I just don't think it does. Well, it's unlikely to, but even rolled and maintained in an orderly fashion. Richest country on earth, huge wealth inequality. Yeah, okay. So his point is that he's making is the Gini curve there. So we just show you the chart again. Whoops, I made it a big chart. Let's clean our face a little bit. So 1.14 was his number. So let's get back there. Sorry, the screen big and small is jumping around a bit. So another one on credit card, and then we're done. This guy had it closer to, I don't know where he got his stats from, but annual inflation rates, 6.5 up. That was up to 2022. So he's behind, but he's highlighting how much people dipped into credit card rates during that period. So what else? There's also the banking system. So we know our friend Warren Buffett. So let's also, when we talk about equities, you don't want to be there on the last day before the crash. Warren Buffett has had 7 quarters, almost 2 years, that he has been a net divestor and is accumulating cash capital that is rolling in the money market funds, etc., out of equities. One of the ones, the biggest one that he was selling is Bank of America. He's also been selling Apple and many others. So you're talking about somebody who is exiting some core holdings after massive long runs, which have been profitable. So if he thought there was more upside or it represented value, recent statements has been that he sees it, the stock market, representing more of a casino now than valuation. So, you know, that's not confidence in good pricing. And you've also got to remember that this is an intermediary of debt to people, for which we've just been discussing credit card debt and other aspects. It also has a institutional side, which deals with debt to corporations, probably commercial property, and lots of other things that it has exposure to. So everything that's bad, post-2020, we just don't need the office space that everybody else has been utilizing. People work from home. There's much more remote stuff, traveling into crime-ridden cities that's like New York and LA and San Francisco that people no longer want to do. You know, the girls don't want to be attacked by a homeless man with a brown bag and an erection anymore on the way to the office every day. It's kind of a bit of a drag having their frocks pulled on by a filthy guy who's defecated under a bridge. It's, you know, they're a bit done with that. And that commercial property vibe that goes with that's all got a massive down leg. It can't be repurposed easily for residential. There's big problems. I would imagine that large amount of these larger banks, bulge banks, are technically insolvent and have been for a while. And you've got a 22% profit decline expected. I'm amazing they'll make any profits, but you know, who knows how the numbers work. There's a bit of an Enron-y type feel about the likes of Tesla and the banks and how people do reporting nowadays. I no longer get the feeling that I have confidence in financial accounts on any great degree personally. That might just be me. I might be a conspiracy theorist or a bit too radical. I don't know. You can decide for yourself. The big thing we'll come back to is obviously gold. The other things that's going on in the credit market to consumers is something like the car loan crisis. And wow, as I say, this as a sidebar, I've developed a personal hate for the Cybertruck. I think it's the most. I saw it when it was first put in front of us, and I thought, what a pile of garbage. And I think now that it truly is a bad quality made piece of absolute garbage that could never sell in Europe. It has no crumple zones, none of this. You get hit at 15 k's per hour and a zebra crossing on that thing with that leading edge, which got no flex in it at all. It'll snap your spine. It's 3 tons. The old school batteries that Elon is using compared to BYO and the Chinese. Wow. I mean, we've got a thing to do on, I put forward a Twitter. This is kind of a sidebar to this video, a whole thing why I think he's going to cease to be an acting CEO. He's going to get a new CEO for Tesla, and he's going to start this thing himself. It could be the election. It could be Trump gives him a political role, but that thing is a burning, absolute burning dumpster. That Tesla, and I feel that I'm looking for great opportunities. We discussed this in our community actually, for entries to the short side. However, there's been shorters before that have been killed. Many of you, we've actually gone long Tesla, by the way. We're not a perpetual hater, and if we don't get the chart for it, we don't short. But the fundamental story and the news starting to leak out, I think this has got too big, and that's another car version of an Enron. We're seeing other car makers in real trouble. Of course, the Germans chose to shoot themselves in the foot. Russia, man, bad. Why don't you just Forex my energy costs? And now you have Volkswagen almost bankrupt. You have BMW trading below its net asset value. Mercedes trading below its net asset value. I mean, there's a lot of people been doing some serious dumb stuff, but that Cybertruck with an A-frame profile has to be one of the dumbest things I've seen. I just thought I'd throw that in for a little bit of profile, and there's plenty of people doing far more work on the deep dive on that on YouTube for you to enjoy. But technically, we think it's early, but we do have the early whiffings of something that may be coming eventually for that to be a beautiful short. On its own merit, nothing to do with overvalued stock markets, although that's just a bonus and a gift on top in the mix. It's a bad thing. It's a very smelly pile of fish. Back to the car loans, however, which is, of course, the clients that are expected to buy these things, and it's no longer so premium. I saw these trucks on the road. It's just kind of like a very heavy sports car that's pretty bad off-road. They don't look great. They take a bunch of space. And I don't see the farmer, call it if you want to be mean, the redneck community guys embracing old cyberpunk, and I don't see the Californians wanting the 3-ton vehicle. So that's one I think is going to be such a lemon. But back to the car loans. These are the clients that are supposed to be buying the cars, and we have delinquency issues, serious delinquency issues on US auto loans. They are skyrocketing. Auto loan 90-day delinquency. To bear in mind, this is you have a car payment and for 3 months you've not made it. Not 1 month. You're not like, damn, there wasn't a balance. I'm going to have to sell some stuff and just cover that and get it back on track. 1 month. This is someone who's no, pass. Second month, no money to the bank, pass. Third month, no. Beyond 90 days, and the letters and the follow-ups and what everything going, I've paid nothing on my vehicle. I've signed a contracted deal. So I mean, you know what would be happening in your rental property. Well, used to before we became totally communist. Now you can't do anything. In fact, in the UK, another little wee sidebar for the fun and games and the joy of the planet and its Bolshevik direction, is in the UK now after 3 months, if someone then makes a small contribution of any form of money, any legal process has to stop and can only start again when he misses 3 months again. How fun is this? But anyway, coming back to our vehicles. The percentage has almost doubled in 2.5 years. Auto loan delinquency rates at around 3%. Serious delinquent auto loans have been rising at the fastest pace since the 2008 financial crisis, so it's going up. The trajectory is fast. At the same time, auto loan debt held by Americans rose to. So you're talking about credit cards, and you've got vehicles at 1.63, which is almost double. So you might have been approaching $1 trillion in car loans at 2008. No, it would have been around 850 billion in 2008, and now you double. And now you're climbing at the fastest rate since the subprime crisis, the great financial crisis, as they chose to call it. And you've got the same time, you've got guys on 25% on their credit card as well. So the guys not paying their cars have probably also got maxed out credit cards. Let's not fool ourselves. So meanwhile, car insurance costs, of course, thanks to a lot of sudden, strange and weird weather conditions that seem to have popped up all over the place in places that have useful minerals that might be very valuable for extraction if there weren't people in the way. Meanwhile, car insurance jumped by 15% in the first half. So your inflation is supposedly 2 or 3% now, given what Pyle's done, but your insurance costs are going up on your vehicle at 15%. Oh, okay. So that's one component that's overperforming and getting kind of expensive, isn't it? So insurance is going up. You can see it here. Let's have a look at the chart. Again, thanks to this person who posted. It's coming from Bloomberg Intelligence. Data Science Abo Reach. Total auto loan debt balances and delinquencies up 2.88, going up at the faster. And let's be clear, 2008 was the winner on most fronts in terms of debt and delinquencies and pain. So just to be matching that rate, it's not going to stop and do that. It's going for at least that high point, if not higher, in my opinion, higher still, and we are part and parcel of that. And at the same time, you're looking at what's our red line, total auto loan debt balances 1.63. As they've said, it's nearly double. I was wondering if we were getting our insurance costs on that, but we're not. So that's kind of interesting. So we've covered credit cards, we've covered auto, more on credit card trouble here. Wow, and by state, we don't have to break this down by state at this juncture or point. We just can take the top line number and see where it goes. So then over here, so S&P 500. Now remember, the only time we said, and we took on Dave Hunter for calling a moonshoot on the stock market, was at a head and shoulder. And he said, at this point in time, that's not a good call. It broke down, it made the head and shoulder downside target. In a stagflationary environment, actually equities can continue to go up. And if there is a bleed out of these huge debt markets, and pension funds and institutions are doing any form of repositioning, you can get a lot more stupidly priced before you can have a crisis, because there's a wall of money leaving one place. But as I say, it's going to be bleed out. You can't dump debt. Amazingly, despite being one of the biggest markets, it's one of the hardest things to sell in any great volume, as the British pension fund found out when there was no bid, and they were not allowed to chase the stack down and collapse the market. They had to go, please sir, can someone help me, sir? I need to get some money, sir. You might recall that. So the fact that you can build up an incredible market cap, yet actually have quite low liquidity by scale of the total value of the market at the bid and ask spread for getting out, is a concept that many people don't understand. You think automatically, if a market is massive and runs into trillions and trillions and trillions, that it's absolutely easy to clear out 100 billion on the bid at the market price, and that's where you're 100% wrong. If you've got 100 trillion in debt in a market, you should actually be able to get out 500 billion quite easily. Well, actually, no. You'll probably find that it starts to get quite tricky quite quickly in terms of that. It's very much a case of you put your hand through that hole into that, call it that massive cookie jar, to play that game, but you actually can't pull it out in any great hurry. It's really restrictive on the exit by scale, given its relative size. So I'm not saying people have been successful in completely rotating out of debt. I'm saying at the margin, there is an element of this wanting to happen and potentially happening. And some of it could also be going into the likes of the gold market, which is tiny in comparison to the debt market. And even the equity markets is significantly smaller, the global equity cap. So the stagflationary period could in fact see, although I think we can get a harsh dump at some point when we get a problem reaction solution event, significantly higher stock markets across the world. But that euro, that dollar, and everything else that is being valid in, because of those collapse of the debt, remember it's the same, the debt and the dollar, they take a chance to crush the debt value and reduce the value of the currency. You don't notice the currency devaluation because it's relative to, it's only ever being compared to other currencies. The category is going down and the debt category is going down because your living costs are continuing to get ever more expensive, and the inflation is the great tax. It is the policy that every nation state is perpetuating against its citizens. Hence why you have to have the bulk of what you earn and live in an asset that is going to retain its value in a hyper-stagflationary environment, which means stubbornly high inflation and very low growth, low job increases low, everything else. So that's the trap that they've captured you in. They gave you the Goldilocks because they knew you would all join the free party where there were lines of cocaine, strippers, alcohol on the house. Hey, binge, 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 heroin for the masses. Their great financialization of everything without too much perceived inflation on your everyday costs, because we exported everything to, we workshopped everything offshore in the great globalization experiment under Alan Greenspan, and they let the asset price inflation start. The first inflation is actually the stretching of asset valuations. You got property stretched, you got housing stretched to multiples that's never gone, you got equity multiples stretched in the dot-com boom, you're seeing it again now. All of those, that's the beginning of the inflation, and then eventually you got the commodity-based inflation on the input costs. And now they want to reverse the offshoring of your workshops and say everything needs to come back, and boy, is that going to get more expensive. And how they're going to do it? You in the West are going to become that same cheap labor that you were once laughing at that was making your stuff on the cheap offshore. That's what's actually happening. How they're going to do it? They're going to level your wealth that you're going to be working for peanuts and competing with a bot that's trying to learn what you do it better, faster, for longer. That'll eventually replace you. That's the danger you have to think about. And what are we seeing here in this rising wedge chart pattern? And it is, I can confirm it is, good call, rising wedge, extreme at highest market cap to GDP. So you're talking again about the equity market, you're talking about the S&P 500, and you're looking at it, and in terms of the gross domestic product, now that's a very interesting word, particularly in the case of America, product, production. You've produced something. In actual fact, the big lie that goes in economics, and this measure is fatally flawed, is that GDP is the same as you can do gross domestic consumption. In other words, minus the exports. They have phrases for it. The exports is a Z versus your imports. I think the imports was it's either E or Z, I can't even remember. So the net of your imports and exports, whether you're an exporter nation or an importer nation generally, your GDP is equal to your GDC, where C equals consumption. So they've equated these two things. But the problem is everyone can consume, especially if you become a nation specialized in consuming and you buy products that die really quick. They're talking more and more about car engines that are not designed to last anymore, the built-in obsolescence, and so that they can get you around as a customer again, as a corporate strategy. The consumer nation of buying things that just quickly fade to grey, as if it's a producer aspect. And especially when you add that this consumption component is being driven by debt that you technically still owe and can't pay, what's actually happened is you've said, I'll buy that, trust me, I'll work it off and pay for it one day out of production of my own, that you've never done fully, and you've put it on an tertiary extraction bill that has got an interest on. That's the America nation. You're lying there with your fat belly and ordering a Japanese sushi and a Chinese takeaway, and you're gobbling it all down, and a German beer and all of this, and you're saying, put it on my tab, put it on my tab, on the basis that your consumption will eventually match your production. You're going to go back from your holiday and work, only you continue to be this consumer, getting fatter and lazier and sicker and fuller, and your bigger debt with an tertiary extraction on it that in the end doesn't actually get paid. You're never going back. You're never going to have that hard work moment. You're staying in the party with all the intoxicants, the drink, the drugs, and the good times, and that's your life. You never go, get up early, get healthy, and get lean. And eventually it becomes your normal, and it's a trap. And everybody, you owe everybody, and then it comes to a stop. You know, the strippers want paying, the drug merchants want paying, the people bringing the drink want paying, the people cleaning up around the swimming pool want paying, and they're sick and tired of you saying, come back tomorrow, I'll pay you plus 10. And this is essentially what's happening. So the rising wedge pattern here is getting into extreme degrees of valuation to the gross domestic product, which is what you can consume. Now, of course, so the relationship production and consumption, as I say, I've already highlighted. What's actually you should need to bear in mind is the production element of America is their ability to actually consume. Yes, they work and they create some products and they sell them too, but they're net importers generally, and they export debt instruments that nobody wants anymore as assets and dollars. You're net, this is the Triffin dilemma, as the major nation, you're an exporter of the currency of the globe, and you are pushing all that out and the assets that people don't want anymore. And now there's a large part of the country that doesn't want either your debt and even to deal with your dollar, which is the beginning of the end. This is what my issue with the nationalists that are super pro America's still going to win and work it out. No, it isn't. And to my lovely American friends and followers, we love you and we want you to win. We don't wish for your death of your nation. The extractors have perpetuated this cycle. They've done it to other nations, and they will do it to the future nations that they are fleeing to. The parasites are jumping from a dying calf that they are, as destroyers, they have successfully destroyed, and they are looking to a young, fresher calf that in due course they will destroy there too. So don't worry, you're not being specifically persecuted. It was just your go. And that's kind of how I tend to frame and think of these things. So he's suggesting that you could get a blow off top and eventually you could crash. Now you could crash out of this rising wedge. One thing I will note is that in terms of this financialization of everything, especially in a stagflationary environment, it's a doomsday game to be the guy that always catches the perfect moment of a short on an index, because you can be wrong 20 times before you get that one right, and it can be super expensive. They've certainly shown they can keep the maidens dancing long after the hull of the boat is below the waterline, and the band will still be playing. So be careful. I'm not sending you out on a spy, an immediate spy short. You want full technical justification. The fundamentals have been there for a while, and I would have very tight stops, and I would expect to lose and to try 3 entries, and then I'd back off and review my whole hypothesis. However, were you to get it right, you could get a substantial sell-off. That said, in due course, the solution is liquidity and will move higher, and stagflation, inflation, and once again you could go high. I just think the Western stock market as the lead stock market, that era will die, and one day you'll have the peakest, typically the Nasdaq and the S&P have traded much higher valuations than any other stock market in the world. That turns as they move their hub to the new fresh young calf that could be, and I'm not feeling I have to say where, but in due course that could come, and that could be the final time your particular stock market ever had the super stretchy valuations. And then you become a welfare state with the large middle regularly being weathered out so that mining and extraction can take place for the people that have now moved to live elsewhere, and you become a version of Africa with a welfare state on the peripheries in high-rise buildings. And again, I hope that doesn't befall America and my American friends, but the risk is indeed there. So that was a bit of technicals about gross domestic product as it is typically measured, and how you are at an all-time high, highest market cap to GDP in US history. And what is the percent? Let's have a look at that chart one more time. Again, let me just shrink that down. I'm not sure we're getting a number there that's I can throw out to you. Of any particular value, but it looked like it was in the region of, he's calling, I think, 200%. Okay, what else is going on? What me worry? That was Alfred E. Newman of Mad Magazine, the guy with the missing tooth and the crazy hairstyle and the weird grin. Yeah. I can't do it. I've luckily still holding on to my own teeth for now. I let the hair go. I had to do a deal with the devil. But anyway, puts, people just aren't buying puts. There's no risk. Hey, now puts kind of like car insurance. It's just about saying, oh, the roads are so safe. There's no one on the roads. Everybody drives so well. There's so few people. No one's driving drunk. There's no kids going Looney Tunes. I don't need car insurance. Well, the pursuit of actually the put to call ratio being super low means that people are benignly unconcerned with downside. So it's kind of weird when you get these scenarios where you're at an all-time high on valuation to GDP, and that people are like, nah, what? There's nothing to stress around. Typically, that can look like complacency in the equity markets. Again, this is not a big make the case for an immediate equity crash until you have something technically there. Don't forget, if there is liquidity that is escaping the bond market, it could indeed be very long-term supportive, and you can get an overvaluation. But there's that consumer, and there's those unemployment numbers that we will also be touching on. Price to sales. So this is another ratio. There's Kevin Gordon. Thank you, Kevin. We're looking at his tweet. So we're taking, a bunch of people's fundamental-based tweets and having a look at them. Now, the only time it looks like you've been higher on price to sales, you'll know the event, fine friends. So we are probably right here near the end of 24, waiting for 25. So that is the beginning of 24, 23, 22, 21, and there was, yes, you guessed it, 2020, and that was March of 2020, and there's your low. So the subsequent event of proliferation, which was on a scale next to nothing you've seen before and was all with a T, not with a B. Don't forget QE 1, 2, 3, 4 and twist after subprime. They started in Bs. This single story was the mega story of them all, and it was in trillion. So you are literally approaching price to sales ratio where actually you are valuing businesses in a manner that says they are worth 3 times their sales. 3 times their sales. Now, there was a period when Scott McNeely of Sun Microsystems, he said, hey, we never asked for you to do this. We couldn't understand why our share price went that high. How could you value us at 10 times sales? He was the highest valuation at the time for his company. And 10 times means essentially, if they had no expenses, no one got paid a salary, their offices were free, they never paid for their ink on their printers, they never had a dime to pay, their gross revenue was entirely their net revenue, no tax, no nothing. 10 years of sales to just get back what you paid for the company. And that's not taking in inflation terms. So if you did a net present value on that, it'd probably take you 15 years to compensate for the decade of inflation that would have run. That's without a single director being paid a cent. Never mind the secretaries and everyone else. Well, clearly that is stupid, and there's margins, and the earnings come out of what's left on the margins on a business. And even tech companies that can have decent margins, better than maybe a car manufacturer, for example, it's still going to be, we get X. We get X after tax, earnings before interest and tax and all of this stuff. So to be the entire, this is 500 companies. It's only been higher in the mid 2021, says Kevin, which is quite correct. That was the post-COVID event. It's only been higher. In other words, when you thought the stock market was expensive in the dot-com boom, and this is the S&P, not just the NASDAQ. The S&P was a bit left behind. There were bricks and mortars businesses that didn't participate in the tech market. This is already showing you how much money is being pushed into the equity markets. We have record valuations for people's 401ks on average, and everything is super duper, and the shares are maintaining a rich feeling for those with 401ks who are sitting with $250,000 on average valuation in terms of what's in that. This is another example of my theory. The liquidity is finding its way into the stock market. That's why the interest rates in the bond market are going up, which shows that the debt isn't going to go back to being highly valued again. Debt valuations down, interest rates up. Remember that. You can only go so far. If you took it back down to naught or very close to naught, it would be very, very high. So Scott McNeely of Sun Microsystems was 10x sales and was the extremity. This guy, who's got his special little look, the leather jacket and black t-shirt look that he peddles out every time, like all these Steve Jobs, Elon Musk, made for the super sales, awesome entrepreneur, hero created narrative. Their record high today, the stock has significantly impacted the S&P. So there was a nifty 50 error in the 50s. That during the 50s, 50 of the stocks took the market up, and it was described as not a very broad market. You're talking about those 50 is the economy of America. Now you have the nifty one. I'm not sure that rhymes so well. I'm going to have to come up with a bag. But the thrifty one, you only need the one. This stock has significantly impacted the S&P gains in 2024. It accounted for approximately 40% of the S&P 500's market gains. In a single year, one stock is 40% of the alpha to the upside for that stock market. Now, if you had ever told me that was going to happen, I would have betted against that being the case. The stock is now valued at 3.5 trillion. Remember the first company to become a trillion market cap? It was Apple, I'm pretty sure. Remember that old gig? We're on 3.5 on 60 billion of annual sales. 60 billion, no, you'll say 60 billion sounds like a lot. No, 60 billion sales number, not profit, not after paying directors and all of that. On a sales number, it's 58 times. The market cap of this company is 58 times. So confident are people that for so long into the future, people are going to so need this chips company is that they've forward sold, not 58 years in my opinion. Remember, if you adjust for NPV, you adjust for the inflation, and then you've got to adjust for the fact that actually this company's got a lot of costs as well. You're actually the equivalent of a couple of 100 years into the future as far as I'm concerned, but on sales 58 times. Wow. I mean, wow. You never that right. Chips could be made in a totally different way in 5, 6, 7, 8 years time. And then what is this? Apart from being the most expensive Enron ever to exist, plus there's the questions of fraud in there, how they account. There's so much to say about this that it's almost best just to leave it right there. 40% of a stock market's gains, friends. Okay, so again, this is super hot money. By the way, dark state pushes things up, creates currency unnaturally high, and I believe they did that with Tesla. You look at Tesla's in the early days of Tesla, you looked at its valuation, how many cars it was making, and it was being sold to you as a tech company, and all of this. Well, Alphabet's Waymo is better auto driving. BYO's batteries are better. They're a better battery manufacturer. Everything about cars now, the quality of the Tesla, the panels on that truck, oh my God, the edges and the cutting carrots and cucumbers. I mean, everything is wrong. There's not a single thing they're winning on, apart from the fact that they've got a Rockefeller New World Order frontman who's going to probably get some czar role if Trump's election victory actually takes place. And then we'll quickly step aside for somebody else to be CEO and take the crash in. In fact, they'll probably give him a year and then get someone else, put a few CEOs in between, good old elongated, before Tesla as a concept quietly dies. And he's going to be Rocket Man, catching rockets in the air. Some of the best CGI I've ever seen. But who knows? Who knows? Who knows? Who really knows? And Neuralink, of course, Neuralink, and the czar of government probity. Let me tell you this much. He will fix the finances. There's nothing he can fix. It doesn't matter anymore. It's long gone. It's long gone. This is again Inception, the movie. The car's crashed over the bridge. You're in slow motion watching all of this. I can come and give the smartest man in the world the steering wheel and the gears. He can be the best driver in the world. The car hits the water. The trajectory, it's over. There's not enough you can cut. Even if you took everybody off everything and forced a major deep depression, there is no saving that situation. I have flown the 747 into the mountain, and 3 nanoseconds before impact, I've given the best pilot in the world the joystick. There is nothing he can save. He can just be the guy on film going like that. It's that how it is, guys. There's nothing saving economically for America. Absolutely not. And the other indebted nations too. It is a big washout. It's a planned reset. The extractors have poisoned the entire calf to the hilt, and it is absolutely destined to die in its current format. And there's no medicine last moment that's going to change that. The fact that it's still functioning and breathing and heaving is just part of the process of the crash into the mountain that I've already said. So with that all said, a couple of other interesting ones that's worth watching. So point of debt-related stress for me, I say, can be associated with the subsequent violent swings the other way. So what are we talking about? This chart over here, that's trading for life. Good on him. Corporate bond yields less than the yield on T-bills is just off all-time lows after the rate cut. This is why so many investors are sticking in money markets, not being compensated for the extra risk and the lack of liquidity. So this is all signals of a debt market malfunction. Debt market malfunction, excess liquidity, full returns, all of these things. Firstly, I wouldn't want the BBB corporate bond debt. It's absolutely awful. I wouldn't want to hold it, and neither do I trust the money markets right now. But the point I was making on top of his tweet, which is kind of interesting, is if you look at this, and again, let's just try to shrink that down a little bit. The key elements are there are periods when, and this is quite common, when you get to the extreme appreciation or lack of appreciation for under return for higher risk, which is basically here, this period here, that period here, and you are here today, which is almost a record, but for the 73-79 era. What has typically happened at those most extreme points? You go from complete under appreciation risk premium to an absolute smash out. 1932, Great Depression. These three were all part of a surge rest, surge rest, surge rest inflation cycle. That's your 1979, your final one. Boom, into 82. Peak Volcker, huge rates. What actually happened during this period? Gold, $800. Gold, reprice. You getting the theme? Gold, reprice. 2007, 2008. 2000 was the absolute low in gold relative to other assets, 2000, 2001. You started to pump the property boom, 2000, 2007, 2008. By 2011, you had a gold peak high at 1927 and silver at $49. So even this one, with the subsequent cure of QE, gave you in 2011 gold bull market. So to summarize, every time You are not being compensated sufficiently for the extremity in the difference between the BBB corporate bond market and the money market in a 3-month and a 3-month T-bill yield. You are at these extremities, so you're more than one standard deviation away. This is what this is showing you, to the downside and to the positive side. You usually get a wild and ruthless, in the opposite direction, super surge that smashes you beyond the first deviation to the direct opposite side that you were originally. So, and in all cases, revalue up of gold, massive gold run, subsequent reaction and remedy, massive gold run. Not super massive. I still say the 2011 was actually a baby bull market. It was just the first leg of an unwinding of the financial that we're still part and parcel of. So here you are in 2023, and is it the 2007 awaiting the 2011? The 2011 was the high, by the way. Is it 1929 waiting the 1932? You're in Great Depression territory quite clearly for us. This is a globally synchronized, and it's far bigger by event than that event, because you've synchronized all the global world economies. So what am I saying here? My take, hey, you want to position today for that eventuality, and the immediate aftermath of that eventuality, which the peak was 2011. But that can come, fast. It can come on that date, or it can come following that date. But you are here. And actually, gold was cheap then. Gold wasn't, I don't think it was cheap 1979, but it hadn't hit its 800. We'll check that on the chart in a minute. And it was cheap there. So all of these were gold buy zones. So if you think it's too late, those are your gold buy zones. You'll get your year date and the mega top of gold later. 32, 82, 2011, after the QEs that resulted from 208. So roughly there. So that is something for you to consider. And the key conclusion I come to is what I've been saying. So we've actively sought all the gold channels over the last 2 years, because we've seen the debt following from our macro call of debt capitulation. We have warned that equity markets can continue to shock to the upside on a stretchy multiple for a while, but eventually, if the consumer is so wrecked, things that rely on consumers will have to crash because the matrices would get too big. But the most important part is the reserve asset return of gold in the financialization of everything is here. And this chart, I thought, highlights it in a very interesting manner that you would potentially enjoy. So this is something else that, as I say, is fascinating. By the way, also this tweet, bonds yielding more than stocks, just goes to show the fact that debt as an instrument is unfavored and equity is preferred. Why would that be? Well, Granny, Yoda, Yellen, Yehudi is smashing it out. Last time we heard at 81.5 days, 1 trillion. And in the last 6 days, some people told me they managed over a third. I've seen articles of 1 trillion. So the pink crocs are coming thick and fast. And you've got them, your roof is full to the ceiling, and another 10 oil tankers with containers piled 30 high and 100 long are coming with some more. And you better have the storage space because they're going to offload and go. So as you can see, you're getting higher. But important point, all of which in true inflationary terms are underperforming the cost of living. And everyone does have a slightly different cost of living depending on what you do. I don't do any major big bang things. But if I fly, I want a good seat and to lie down if it's long haul. So the cost of those tickets going up immensely will affect me more than the cost of buying flash cars, for example. But the key point in all of this is that for just about everyone's different inflation rates, both of these, we are in a negative real return environment, which is actually the perfect environment for something that never changes. And again, Pure Gold links below, ITM Trading's links below for those in the States, if you wish to buy. That doesn't have a negative interest rate being nibbled. Every day I come and hold it, it weighs the same. It hasn't been nibbled negatively. It hasn't been reduced. It's still there. It's still in its box. Because I'm using this one as a demo version, its box has got a bit frayed. The metal is unharmed. It weighs exact same. It's covered in plastic. Even my greasy little mitts can't make a oily little mark on it. And it is true, real money. That is a kilo of silver. And I just love getting it out. I don't know why I put it all back again. I just love getting it out. It just feels right. Feel that weight. Feel that weight. This is money. This is your asset reserve in these times. Do not overtrust the digital. Do not overtrust the likes of Bitcoin and crypto for now. Have it as speculation. My community knows our special coin that we expect to outperform Bitcoin and also has better downside performance if we are to get the controlled problem reaction solution crash. Very interesting fundamentals, and there's still a big cap. It's within the top 20, and we will expect it to hold up very well, even if you did get caught in a downswing, and it makes up a small percentage of our overall holding, for which precious metals is the bulk for surviving and retaining our asset class during this reset period that you physically hold and control, not in a bank depository. So, you know, you've got the map as to where it's buried. And so, yeah, that's kind of fantastically interesting to me, I find. The other things that we've highlighted. So we're doing a kind of macroeconomic walkthrough. See if we can get through there. It's nothing like a democracy where you have a chosen one, ensuring that all the Orthodox Christians, Slavics, are being grabbed and dragged off to a front to fight other Russo-Slavic Christians and get their organs removed and killed. Literally, I find that rather insulting. Of course, we've got Peak Elon bragging about his clever catching flying rockets that have got just one end of it being controlled from one end and never turn into tumbling cylinders. What's happening here? Airbnb. So the Airbnb I treat with the usual suspicion. They love the idea of you putting in cameras and all of that and watching. They look at your house like it's their house at some point in the future. Uber and all of these. We don't have any assets. You know, it's all this. These are all the reasons why you should be happy and own nothing. Look at these guys. They don't own houses and look how well they're doing. So Airbnb, this is the kind of thing, the transaction taxes that kind of come in, hotel tax revenue, it's at an absolute low. So apart from COVID, which had a very specific reason, nobody was going on holiday. You were told to stay at your own home, not go and live in other people's homes at some holiday destination. Apart from that, this is the worst ever. Airbnb. For tax collection and transaction. So Airbnb is failing. That means you're not going on holiday to live in other people's homes because that tax isn't being paid. Demand tanking, Ethan is asking, so we thank him for that tweet. And it is indeed quite an interesting one. So let's have a look at some of the charts. We've done a bit of a news rebase. So let's also remind a lot of people. We said this 2000 take would be seminal and you should be in it. This is what the gold has done during this period. That's the move you've got from owning gold by hitting that link below. And I'm telling you, you just started. That's not the CPI adjusted chart that I've shared many times. It's not the gold relative to many other assets that are hyper valued at the moment. It's not a lot of things, but it is incredibly encouraging, and it is a macro call. And when we go up to the really big time frames, we tend to get those more regularly right. What else have we got for you? Well, let's take you into that whole problem reaction solution and that whole balance sheet liquidity gig that the big nations have brought you. So in terms of liquidity, this is Japan's balance sheet, and it's in yen, so I've adjusted it for the yen. The Chinese, I've adjusted it for the won. The EU, I've adjusted it for the euro, and the US, which will be in dollars and needs no adjusting to dollars. So you have a dollar element of balance sheet. Now, I don't normally use moving averages, and I criticize MACDs and indicators. So some of you might be going, whoa, what are you doing? Why is all that stuff on there? I wanted to show you when the moments of acceleration go away from a moving average are occurring, to highlight when liquidity surges are coming. Because essentially, I think they've got a problem they want to drop on our heads in the not too distant future, and that we'll get the subsequent reaction solution to follow. And the key thing is when you add these big nations' balance sheets together, this is what you see. You can see the moments when things surge. You see, this is liquidity. So you can look at this. So what I've done is, here's the overall expansion of balance sheets. What you can see is when they are taking liquidity out, let's grab that one, just before the red.
Book your free call now to discover how the HVF method can transform your trading and investment strategies. It's quick and easy. So easy, in fact, you can talk to us today. Just click the link in the description or pinned comment. Choose a date and time that works for you, and let our expert traders show you a revolutionary approach to trading the markets. This could be the breakthrough you've been waiting for.
And when it came back in. And what you'll note under the nice fat transgender pink is that's bang on time for the crisis. So it wasn't the chart that made the crisis. The chart is showing you the crisis came. And that's when the proliferation, and it was a huge proliferation. So this is all log scaled. If I were to take the top and de-log it, you'll see even more extremely how much of a surge you got in absolute terms. But we're currently in a constriction environment. This is why your Bitcoin guys are mad, because Bitcoin ain't running. And I've said before, Bitcoin is essentially a liquidity proxy. It relies on proliferation. And Bitcoin, of course, got its 67K round about here. End of 2011, 2022, we can go and find that chart and confirm it. When did you make your 69 high? November 21, as we say. So there you go. That's February 22. You can see it's all the pump of the liquidity in terms of what went into the balance sheets. So this is a period that you've been drained. And when you're in a period that you're getting draining liquidity, hurt the consumer, hurt the retail guy. This is where we are now. What comes is the crisis and then the pumpamental. So before you can get the green bars, look where we are now, you need the problem bars. So we are winding down. In fact, we're getting quite close down. So there was a lot of tightening going on, a lot of liquidity removal. That was pretty ugly, the descent. We're still descending at the moment in terms of liquidity, despite adding in the Chinese and all you hear about the Chinese. But overall, the balance sheet growth. And if I were to include the stock market or Bitcoin here, you will see, understandably, that the liquidity measure and the expansion of balance sheets is the expansion of the asset class. In short, you live in a virtual reality game where the controller classes of liquidity determine the value of things by whether they turn the tap on or off. And this green and red chart, which is a MACD, for illustrating on when the key moment comes on the balance sheet expansion, almost will tell you when your false flag attack or orchestrated event or war or whatever the theme for this game show is going to be, when it's coming. And we are getting to that point where it doesn't necessarily have to be too far away. And the other interesting aspect that I absolutely want to highlight to you here is the increase of volatility to get the same bang for the buck. Look how shallow that red dip is. Generally, these events are getting more extreme. There was a big liquidity super surge. They started to taper it there in 17. Now, you might recall, how many times have we said 2016 was a big year? That was Shanghai Accord. The rest expanded their balance sheet to cover for China that did the property gig and did their version of 2008 only 8 years later and ran out of money. They created heat in the economy. When we did the Western world, that was a huge downdraft. But you know how much worse it would have been? Ask Australia particularly. If China wasn't buying copper and knocking up buildings and doing a whole bunch of things at the same time, then you have here, we had a couple of points where we had crisis. We got really, really tight, and that was your big one. That was an unbelievable stimulus. And I expect with this additional, and if you color by zone, this has been contractory for quite a long time. If you color by zone, the area is getting bigger below the line, and each time the response required will be bigger too. In other words, I'm sitting here telling you that central banks create volatility. They don't counteract it. They are, and they continue to expand it. And when they want to destroy it, they're going to make ever bigger whiplash movements of liquidity to shake you out. So people getting hurt right now, I think we need a final major dose of real pain. Event. Put your guess of what that event will be in the comments below and tell me why you think it will be. Will it be war? Will it be Taiwan? Which war? Do you think it'll be bank crash? What do you tell me? Marburg or something else? You give me your best guess. I'd be interested to know what you guys think the theme will be. But as you can see, these are then leading indicators for when markets will turn Bitcoin to the upside and gold further also to the upside. The amazing thing about gold is that while since May, Bitcoin has floundered a little bit, gold has continued to run on the deflation of the debt market. So in spite of it not being a pro-liquidity environment, it has run. So after the 2020, you can see what gold did. It actually shook off the 2020 events. That was your candle for 2020. So I'll say goodbye to the 80s way back there. By the way, that's the highest point on a CPI adjusted basis. Don't forget that. And we've shown you that. Let's show it to you one more time, just so that there's someone who's watching this for the first time and doesn't know what I'm talking about. What a performance from gold, by the way, so far. So that's adjusted for inflation. We said this is a triggering event of a macro upside HVF of umpteen multi-decade scale that will see those that hold the magic physical G for gold be in a very powerful position and retaining their buying power in an environment where the many will be losing theirs. That right there, and then I need to log scale it because the multiple of overperformance is that vast. So you're going to overperform the inflationary effects by a further, and we're at around 8.4, getting to 52, probably another 6 times still to come. So this has just triggered our macro HVF, and it just broke the capping descending grind line, which is that red line that is coming down off our CPI adjusted gold price. This is going to be a huge performance. But what we were talking about, we were talking about the liquidity surge and what it would do and how gold performed during this period when most of the liquidity was being pumped in from the March, certainly through to September, and then when we started to take it away in November 21. So if we have a look at gold in that period, that was your, where's it? Let's go back to that month. Now I'm going to take the CPI adjustment out, because the CPI adjustment literally has made the collapse in gold, which was very small. I don't know why I even used the word collapse. Reduced it to that single month event that saw you trade to the downside to 14.56 before coming back up and smashing on upwards to the 2075 high, which was achieved there, 2075. So it was literally within the same month you tested a low, you returned back up, and you continued higher. So that was a good period, and you continued to perform well. Thereafter, Bitcoin got the liquidity that came up, and you got your 69,000 in November 21 for Bitcoin. That was around there. So both those things performed exceedingly well. Gold had already begun climbing before. So being in gold first is the trick. Before silver, before miners, and before Bitcoin, which will be a proxy and probably will be pumped. But be careful. Don't trust it. You know who runs that gig and show. So that was the liquidity. What did the SPY index do? Let's have a look at some of the other aspects, the equity index. Here you can see that liquidity proxy that we established for you, and we were showing you, of all the balance sheets of the different nations. And what it shows is, let's get it back, there we go. What it shows is you would have had a surge around about February 2020, the last month. February 2020, not Bitcoin, sorry, we want to get that. Here's your collapse on the same monthly chart, March 2020, and there's your liquidity coming in. Up and into January 22. Then you had your first correction. That was the period, by the way, when we were warning not to be. The only time we've said not to be, there was a head and shoulder in the equity market. And how did that show up on the liquidity? January 2022, where is it? You see, the liquidity stopped and you started contracting. The surge, the rate of entry of liquidity was convex, like that, and then rounded out, cease. And since then you went contractionary. And that is in and around the early part of 2022. So liquidity is the market. There is some delays. It's not an exact science, but market go up, be in front of a wall of money that's charging into it. It shouldn't be controversial to say that. So we've done a little bit of a macro deep dive. Let's finish with the charts. It's been an interesting and lengthy chat, but it is part of illustrating that this is a proxy of liquidity. You saw that, which I showed over here. You've been withdrawing liquidity, hence why you've been in this holding pattern for Bitcoin. Oil, once talking about, down today. We've highlighted that with a wrecked consumer, it's going to be a difficult potential environment for oil, even on a devaluing dollar. Even on a devaluing dollar. I will also highlight that you've got a bit of a broadening structure coming out here. After a downside sell, you got resisted at our midpoint of our funnel. And we prefer gold. So the energies is not the best place to hide for the process I see coming, your monetary commodities. And this is the difference between us and all the commodity bulls. There's a lot of people that want to just go uranium, go oil, go. Now there are different markets, of course they are. And you know, uranium might do quite well. Be in the monetary commodities. This is a monetary commodity moment. This is a monetary failure. Have the backstop of the all-time multi-millennia commodity in your favor. click the link below, book a call, be well directed by us, trade it technically, utilizing HVF method. We've done it for countless people. We do it for ourselves. We continue to do it. It's our best life. And we live a great life, and we're free, and we live in 3 different places, and we travel well, and we can work anywhere where the internet is, and we can make profits on trading. We can convert it to gold, and we continue to have a better balance sheet than anyone else, and we can reduce our taxes to a group of people who are already taxing you with inflation by orchestrated design, and then are going to use that inflation to say you've got a very high salary or your house has gone up. Those liars and cheats are there to steal from you in what they put forward as a fair manner. And I'm saying it doesn't sound fair to me. Okay? Click the link below, book a call. And buy your gold. Buy your gold, start with the gold. Pure gold, rest of the world. ITM for the US guys. Links are below. Bullion Vault, start if you've only got $10, $20, start the internet buying. And once you get to a key level, you can swap it over and you'll get the upside of the move in the meantime. Start monthly. So oil is a different category as fish, and we continue to assert that we expect to see it fall despite all the wars. So you'll look at this chart here, and I'm here to say to you, I saw this a couple of times and told my community and said the SPY will go higher. But do I really want to be the climb the wall of worry guy entering in that? I'll take the gold rather. In terms of investment, you've actually got wicks that dipped and were rejected a couple of times that point to the SPY going higher. But at some point, it can eventually get too high. When you get this very low volatility, continual upward move like that, kind of like where we are, you are 1, 2, 3, 4, 5, 6 months, largely all up. And if you ignore the one red, you actually have another 4 or 5 months in there. You get this walkout type market that can actually go for quite a long time. Relatively low vol and going higher. It can go for a long time. You had a little bit of it here. Post the crisis. This is a little bit post a pullback moment. And you're going higher. My take, driven by debt. Remember, the liquidity is not is being withdrawn actually from the balance sheets perspective, if we can really trust them on those balance sheets. But with what we've got as a guide, whether are they contracting, whether they're truly contracting, and how much, we can always argue whether they'll even give us honest information. The key point is it's a proxy for it. You're probably getting bond-based support, market money leaving incrementally with whatever can be traded at, and that is why you get the particular move that we are highlighting to you that is on the US 10-year, and I will bring it up for you now. The fact that the 10-year is going up in rates while they cut twice in one go, and the original expectation was for further cuts to be coming. Suddenly, a number came in that put that into doubt. It's funny how there's always a useful number that puts that into doubt. Why do you think? Because the debt markets can't take lower rates. They don't have the conviction, they don't have the bid on being a higher value, and they can't get away with paying lower yields. No one wants to bid for it. That is your story, and this is your 40-year narrative that we told everyone about. That was your peak low 2020. This is a market turn, fine friends. It is a turn in the debt market in terms of its acceptability as an ownership asset proposition for others. Negative real interest rates for an extended period into the future. So I've just pivoted to log. You can see how huge in percentage terms these later moves were and how significant that is. Once you've crossed that localized high, you are now in a series of higher highs and higher lows. This is a falling wedge. That is an upside continuation pattern on what is actually still quite a new trend. That was an upside HVF. We spoke of that and said you're going to 3% when you were at 1.3%. That materialized. We have made a number of upside debt calls on the yield downside on valuation that have continued to be met on the lower time frames. Here was our 5% call that we made when you were in and around the trading of threes. That was made and then pulled back. You are now in this falling wedge structure for a while. So that tells me the crisis isn't here yet. Some of you say, when? I'd love to be able to get my diary out and go, 11:47 on the 13th of, that ain't going to happen. But I can tell you it's not tomorrow. Overall, my expectation is a third impulse is required, roughly to the capping descending grind line. That's why there's a flag there for this pattern to be completed. And then there'll actually be people that'll come in and say, you're wrong, the debt markets are going up and the yields are coming down. During this period, you will in fact get yields coming down. It may come all the way down. It may make a double bottom. It may make all the way down to the bottom of our falling wedge, the basing descending grind line. But I'm looking for an interlude or an event that sees it at least make the 4.2s, 4s, upper 4s range, upper 4.1s range for a tap out before it rolls over. During this period, when rates are going up, debt is devaluing, the dollar relatively will be strong. Relative to what? Other crap fiats like it. They're all going down. That's why you're experiencing inflation. That's why your liter of milk costs more, your bread costs more. They're all going down. They're all crap. Don't let nationalists that are super pumped on their currency tell you how their currency wins and how awesome it is. Don't let them also say there's a shortage of treasuries. There's more treasuries ever than people know, and they're coming at an ever thicker and faster rate. There's a convoy out here on the sea outside my house of containers with pink Crocs all queued to bring them in. I just have to say, yeah, I really want them. There's a shortage. Okay, come on down. It ain't happening. There's no shortage of debt. So this will then have a down leg period before I expect it working across. This could see something quarter two-ish. If I were guessing, so you all want a time, I'll do my damnedest and I will use the debt markets to predict. Somewhere between there and there and there, and then you've got to get back over, if we're right, to break out. And this points to quarter two to quarter three, potentially, for this to start breaking out. That would mean you're revisiting the 5 again, and on this occasion, one of two things happen. You make a new high and you continue higher, or you get put into the long grass, you turn back and you set up a much bigger time frame pattern to make a much more violent new high, but that starts later, but will go further and faster later. So this break of the falling wedge, I'm calling for quarter two to quarter three of 2025. What happens here will be determined by playmakers that I have no power over. You'll either tap out and come off on down and wind up and go, or we'll continue higher on a major surge. For this flag break, for example, you broke, you pulled back, and then you just walked out higher. You didn't wind up or do anything. On this falling wedge, you just walked out higher. So what will it do next time? I don't know. Also on a falling wedge, you can break out and pull back and pause for a while before going higher. So the guess on the breaking of the falling wedge is Q2 or Q3 of next year. That isn't going to be the crisis because it's not going to be super high rates. It could be at rates much like where we are now. And in this time, we will have gone up and down. So we would have gone fear of inflation, back to poor consumer, it's a recession, it's a depression, everyone's feeling so bad, cut the rates again, let's cut again. So there's going to be a lot of backwards and forwards with the direction of rates. And actually, it's going to potentially go back to softening, and you may get further cuts to bring it back down to here. Or you may not get a cut, but the expectation of them will be changed. And that is a time prediction for this. At the end of the day, gold will see you through this period exceedingly well. And can I point out that when this goes up, the actual asset, inverted commas, of debt will be going down. And I anticipate gold, as a smaller market cap, will be going up disproportionately according to that debt. And your very expensive stock market may have a crash, may soften, which could be the reason why you get these interest rate cut expectations, this down leg over here. Or it may just soften for a while because of being a rival asset class to a failing debt. You could see equities go higher. And at the moment, the SPY doesn't look like it's ready to stop. Okay, quite a lengthy one from us today. Hope it's been useful. This is the kind of things we think about, talk about: macroeconomics, technicals, the combination of both powers, of both macro and technical, and what it means for you. There's a day when I don't go gold. I don't wake up every day and, yay, team gold, 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 gold only. It's the thing for now. It's the thing for now. It's probably a thing safe to have forever. But let me tell you, it's been a pig during the dot-com boom. It was a pig from Faulkner's 82, $800 down, 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 down. It was 200 in 2000, 20 years later. That's a pig. There's a time to be in something else. And the charts will tell you. And the fundamentals will tell you. However, certain things serve a certain purpose brilliantly at the right time. If you're in the desert in a 4x4, you need the jack when the tire goes. You don't need a jack when you're having dinner. And I am not emotionally married to any asset classes. There's people who go, oh, gold buggism means you're always a bug. I'm a bug for now, for the time that it requires. And there are other things we are very bullish and bearish as part and parcel of this. And you can discuss it when you come in board to our group, and you will see our setups, what we like, what we trade, regular updates with myself in person, seen like you're seeing me right here, right now. Only I'm talking to you, my community member, where I say and will give anything. We have live sessions occasionally where you can ask any question you like and check the charts. We go through your setups, the things we are seeing that are trading, virtually none of which I've discussed here, and very rarely, only a small percentage we share outside the community. When to be in crypto, it will go up. I don't trust it. I don't love it. I know it's bringing the digital game to town, but if it's going to come, I want to make the money on the upside when it's going up. And all these things, preservation of your wealth and beyond. And for that, you need to click the link below to book a call. We look forward to having you. We like sound-minded people that wish to build a long, sustainable, wealthy, preserved wealth, optionality existence that will see them best looked after for the current times that they are about to experience. We're in a 4x4 in the desert, and a possible flat wheel is coming. You need to have the tools for that circumstance. It's not a typical circumstance. Reset season is like nothing you've had before. Traditional financial advice will do you more damage. We are non-advisory, but we make it clear what we're doing. Until next time, thank you for watching the video and sharing. We'll catch you later. Bye.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.